So I think it's important before I go into my 2024 and beyond strategy that you understand how the old strategy worked, which is still on this YouTube channel. It's called the Event Chain. And once I explain that, and then you see how I flip that on its head, it kind of makes way more sense, right? So what you're looking at here is the old strategy. So what you're looking at on the left hand side here is low institutional volume, mainly a range, market basically going sideways. I identified this as 3 candles basically in close proximity to each other, really tight knit candles producing a sideways movement. Some people found this a bit difficult to identify, and other people would see it one way, some people would see it another way, but most people got the gist of the idea generally, right? We draw a line through the center of this box, and that would identify the equilibrium of this transactional volume or low institutional volume that's happening right here in this box, right? And then the market would expand either way, up or down, out of this box. And then what I would try and do is trade back to equilibrium. All right. And how I would do this is when the market reached, when I saw a structure that I potentially identified as a turning point, which was a bullish engulfing structure. So as we get down here, and you can see inside here, the market tap back into this box. On a zoomed in view, this is what this would look like, right? There would be, on the way down, the market would create bearish engulfing structures. And to identify the turning point, I would wait for a bullish engulfing structure. But in order to confirm that this bullish engulfing structure has the potential to go back up to equilibrium, it would need to take out a bearish engulfing structure that was created on the way down, and that was the event chain. So it would create the engulfing structure, break the engulfing structure, come back to the same engulfing structure at the birth of the zone, at the birth of that move that broke the engulfing structure, right? So let's say, I don't know, this was an engulfing structure, and then somewhere inside of this, before it hit that, another engulfing structure was created. We want to make sure that we took the birth of the move. So the zone that was created at the very birth of that move that led to the break, not the one in the middle or the one closer at the birth, right? So that was the general idea. Then the market would come back, tap in, you'd get a really nice tight entry because you'd be on a smaller time frame. So let's say this is the H1, let's say you've come down to the M5 or something like that, right? And then you trade it back to equilibrium for the H1, right? Because your H1 would have been your main time frame. And what went wrong with this for me is that sometimes the market would expand out of low institutional volume, whatever it may be, but then just continue going to the downside. And then I'll be thinking, okay, bearish engulfing structure, bullish engulfing structure has taken out the bearish engulfing structure, limit order set, and boom, and I'll keep taking out and out and out, right? And I didn't understand this, and it just kept on happening. So it depleted my account consistently, and then I knew something was wrong. There was something that I was missing with the strategy. A lot of people from this channel found really amazing success with it, and they've probably gone on to absolutely master it, which is great. But for me, it just didn't work out as I expected it to. And I had this idea in my head, right, of becoming a full stack trader, which means you're able to maintain optimal physical and mental stability, right, while being able to trade all market conditions. Okay, and I think that this strategy didn't allow for that because there's a lot of money to be made in sideways movements, right? The market does 3 things: it goes up, it goes down, it goes sideways. You should be able to make money in all conditions, right? Personally, all conditions. So as I identified this was not working for me, I had to go back to the drawing board, and as I do, get back in the lab, go through YouTube videos, try and identify what was going wrong. This is the new strategy. So you see, before I was trading back to equilibrium. Now we're trading from equilibrium. Just this tiny little shift has changed absolutely everything for me. And the pattern itself, um, works the same when you go down to the smaller time frame. So let's say, right, let's say you're doing this on the H1, this sideways movement. What this sideways movement is institutions, banks, whatever you want to call it, really doesn't matter, racking up orders, right? When it comes, we don't know where it's going to expand out of, but I'll get into this on another day, how you can actually trade this very, very effectively. So we don't know where it's going to expand from. So it expands out, right? So before, I'll be trying to trade back to equilibrium. Now, we simply wait for it to come back to equilibrium, right? And then we trade back in line with the expansion. This expansion is actually a directional bias, okay? And this makes things so much simpler because you're not guessing, right? The market has given you a clear indication of the directional bias. So you're not guessing, you're just waiting for the market to show you what direction you have to go in, right? And then you go in that direction. Simple as that. This makes things 10 times easier because when I was trading like this before, I didn't have any directional bias apart from this confirmation signal, but it kept on going down and down and down, which made this confirmation event chain irrelevant, right? So what I've noticed as well that happens within this contraction or range or, whatever you want to call it, I've also identified engulfing structures, right? Sometimes there's engulfing structures within this range which allow you to take the engulfing structure rather than taking the whole range as a zone, right? Which allows you to minimize risk and up your point size and therefore get more out of the trade, right? So that's a nuance that I've discovered inside of these contraction ranges once the market expands out, right? You don't try and trade this. You can potentially try and trade the expand. You can trade potentially try and trade this back to mitigation. But again, the same thing could happen, right? But there is a way to do that because the pattern repeats itself on every single time frame. This is the pattern, right? Now, as I said before about the event chain and what I've discovered, this is literally the pattern of the market. The market goes sideways, it goes up, it goes down, it goes sideways, it goes up, it goes down, it goes sideways, it goes up, it goes down. That's the pattern of the market. It's not game changing. It's not my pattern. It's just what the market does, right? It's just the straight facts. As I said from the previous video, these are just simply the facts of the market. It goes sideways, up and down, sideways, up and down. But this is the consistent pattern that it makes. So once we identify the consistent pattern of the market, then we just play to that, okay? Now, this is going in. If you're doing this, you're really, depending on if you're losing location, which I'll get into another video, which makes things, again, allows you to go in a lot simpler without any confirmation. But if you're doing this, you're going in cold, right? There's no confirmation that this zone is absolutely going to work, so you're going in cold. The way to go in a little warmer is to, let's say you're trading on the M10, which I'm doing currently. I'm actually testing out the M10 and the M30, finding the M10 quite useful. We've got the range, we've got the expansion, we come back in for the mitigation. In this area here, we go down to the M2 time frame and we look for the exact same pattern. Contraction, expansion, play the mitigation, boom, that's our actual entry. It allows us to reduce our risk and up our pip size, right? And then we trade back to either a predetermined risk amount, risk reward amount, or to the low or high. That's entirely up to you how you want to choose that. But this is the pattern. Once you identify the zone, you go down to a smaller time frame, and then you play the exact same thing again. Now, this is absolutely game changing, and it simplifies everything that you have to do on such a massive level. Because if you have a directional bias, that's literally half the battle won. Most people are trying to guess which way the market's going, trying to make assumptions about which way it's going. You don't make no fucking assumptions, you don't guess, you wait to be shown the way, right? And this simply does that for you. Are there other probability stacks that allow you to give you a higher determination of where the market might go? Yes, there is. Are we going to go into this video? No, we're not. But I will produce more videos that allow you to identify these probability stacks that put the probabilities in your favor. And as you stack these probabilities, your win rate gets higher and higher and higher. So I hope you understand how this little shift from here, trading back to equilibrium, rather now to trading from equilibrium, has changed the game. And whether you use the strategy or you don't, it's entirely up to you. But sometimes it's just that little shift in perspective that can change your whole trading outlook from unsuccessful non-consistency to consistency. And that's all what we're aiming for, right?